George Buckley is Chief UK Economist at Deutsche Bank, and Amit Kara, an economist at UBS. Both join me now. Gents, who's on the right side of this debate? Is it Posen and Miles, or is it Dale and Wheel? Which is correct? Amit?
Well, I think our view is that they will not continue with the or expand the QE program in May. And I think the message from the bank will be pretty clear. Even if they did not expand the QE, they will make it clear that they are ready to expand QE if the data turns worse.
So they're going to leave the door open. George, what's your take?
Well, if you look at the data over the last couple of weeks, last week we saw some truly dreadful news. We had GDP revised down, we had consumer confidence a couple of tenths or a couple of points lower. We had the nationwide saying we had lower house prices. This week we've got a very different scenario. Today's manufacturing numbers weren't great, but look at the PMI surveys, which are a better leading indicator. The numbers are a bit better, and I can understand why some people might think we don't need to do any more quantitative easing.
I sat down with John Longworth, who's the head of the British Chambers of Commerce. He said no double dip in the UK. Would you agree, George, that it's a clear-cut story, we are in recovery? Well,
I think everyone looks back to Q4 2010 when we were a good 1 percentage point out on the forecast for GDP. Everyone was expecting it to come in at plus 0.5, it came in at minus 0.5. I actually think we're going to get a positive print on GDP, but look at NISA today. They've suggested it could be very low, just 0.1%.
But just have a look at this graphic that we've got up there, guys. I mean, this shows you volatility. You know, we are in a new world, but it just shows you how erratic that number is. Is it fair, Amit, to say that, George, GDP is a slightly backward-looking number? We should be focusing on the PMIs, Amit?
It is
Purchasing Managers Index, that is.
It is indeed backward-looking, and it's prone to huge revisions as well. So there's only that much we should take from the flash estimate. But, you know, that's the best we have. I mean, the GDP is the biggest survey in the country.
And are we out of recession, which was the original posture?
No, I don't think we are. But, I mean, that's a technical question in a way, whether we're in two negative quarters. I mean, when you've got minus 0.3 and a small plus number, I mean, it's broadly recession-like.
I think however you look at this, though, I mean, the recovery has been very poor compared to what recoveries normally look like. In a recovery stage, 2 years after the event, you'd normally expect to see 3% GDP. We're recovering at between 1 and 1.5. It's a much slower rate of growth than we'd have expected.
But then, I mean, I've heard this phrase, and I've sort of had it banging in my ear, which is, get used to the new normal, forget 3%. I mean, what is the new normal?
I suspect we're looking at somewhere around about 2.25% on average over the next 10 years, if we're lucky. I don't think we can extrapolate what we saw in the 10-year run-up to the credit crisis. In other words, 3% GDP growth. That was an anomaly. It was because of the fact that we saw a rapid pace of globalization, which allowed the Bank of England to set interest rates at very low levels because they weren't generating inflation. That's all changed. We're going to see exactly the opposite.
And Amit, for you, is the new normal 2.5? Are you in tandem with George?
Absolutely. I think the new normal is probably in the region of 2%. You know, there's plenty of sort of academic literature that shows that when countries reach debt levels of about 90%, economies do hurt.
Tell me this. You're both consensus now, there's probably no more QE. What more should the Bank of England be doing to boost growth? George?
I think it's very difficult because when you look at, for example, what's been dragging on GDP over the past few quarters since the recession ended, it's been consumption, it's been investment. Both of those are performing worse than any other G7 economy. We're lower relative to peak on consumption and investment than any other G7. And so what the government needs to do is to try and think about how they can support consumption, how they can support investment. And of course, that's a government job. In terms of what the Bank of England can do, well, keeping interest rates at these low levels, in real terms, they were never this low in the aftermath of the 1990s recession, and that should help support consumption, albeit via possibly lower savings.
Is it down to the government, Amit?
In large part it is, but I think the Bank of England should seriously consider doing unconventional QE. And I know they have the argument that the instruments are not out there for them to engage with. But I think if the bank were to signal their readiness to do it, i.e. we have a big player out there willing to buy unconventional instruments, possibly that market could open.
I just want to broaden the debate a little bit. What is the biggest risk to the UK economy right now, Amit?
I mean, it's got...
Is it Europe?
Europe remains a huge risk. I still think there is an overarching fear that the economy is like Japan. We are pushing hard with monetary policy at full throttle, and yet, I mean, as George said earlier, we're just not seeing the kind of economic growth that we should have during recoveries.
You mentioned Japan. Are we facing, 10 years of a similar situation to Japan?
Probably not. I mean, our policymakers have reacted quicker. But, at the end of the day, the proof of the pudding is in the eating. We're just not seeing the data come through.
George?
There is a worrying trend in terms of what's happening to gilt yields. They did seem to peak and then have started falling just like they did in Japan. Now, obviously, that's not necessarily a good guide to where they might go, but of course it's a worry. And when you talk about the risks, I mean, where does it end? You have Europe, you have oil prices, you have fiscal adjustment. There's a lot of risks facing this recovery, and that's probably why it's been so weak.
And so many of those are beyond the government control. But one thing I want your opinion on is the housing market here in the UK, because it ties in so closely to confidence. Are you convinced, very briefly, both of you, just a response on this, that we've got a robust housing market here, or is it weak? George?
I think it's been driven by London, which in turn has been driven by where sterling is, and it looks to outsiders that housing is quite cheap. The rest of the country, I think there's probably further adjustment to go, so I wouldn't be surprised to see a few years of falling prices.
Amit?
I think from a structural point of view, there is a shortage in this country of housing. And, households have essentially taken on this vast debt to buy an asset that's really in short supply. So I don't think it's a huge problem, but that's not to say that we won't see any fall in prices at all. We could see a small fall.
Well, gents, all will be revealed on April the 18th when we get the minutes of this MPC meeting. George Buckley, Chief UK Economist at Deutsche Bank, and Amit Kara, Economist at UBS. Thanks for your time.